And welcome to the Midday Market Update for August 6th, 2020. My name is Kevin Hill, here as always with Michael Vincent.
Good afternoon, everybody. How are you doing?
I'm doing great. We have a great show for you.
We do have a great show, and it's interactive as well. So get your comments and questions in on FreightWaves on LinkedIn and on Facebook, and we'll address them as best we possibly can, right?
We will. We definitely will. At the bottom of the hour, we have Sherman Barnes, who's the head of sales and marketing with Trio Trucking, joining us to talk about the market conditions and a little bit about the PPP loans and kind of capacity coming in and out of the markets.
We'll talk to him about what's going on.
Yeah, then at 12:40 we have Nate Robert, one of the co-founders of Baton, coming in, which is a really good, great idea that they're launching. And
I find it very interesting because it's a needed service. I think it's a great idea, and it sets them up for future technology.
It really does.
In a major way, right?
Yeah, and it's all about solving that detention problem, which is something that has just never gotten solved in trucking. And so hopefully they'll make some major gains into that.
Yeah, that'll be a great one. Yeah. And we also have people back in studio, right?
We do. This week we do have people back in studio. We have Zach Strickland talking about the freight market. We have our lead economist over here, Anthony Smith, talking about jobless claims. But as always, we'll kick it off with the headlines on FreightWaves.com and our own Andrew Cox. And our lead story today, what is that, Andrew?
Kevin, thanks for having me back. I'm back from vacation. Our first one here is about the truckers and their frustration with the deadline on hair sampling. Again, carriers are now frustrated with the now 5-year delay in the rulemaking that would give them the option to use hair testing rather than urinalysis when screening drivers. Hair testing is not a new thing to the industry. It's been the theme of safety discussions at panels and events for some time now. But while large national carriers like Werner, Schneider, and Knight-Swift have all been pushing for hair testing, the ATA believes that industry-wide hair testing will only move forward when the Trump administration corrects some procedural issues. The movement to hair testing has been held up at HHS, Health and Human Services, for years now, and carriers are ready for a renewed push towards it. One thing that may help them is some recent data that's coming out of the FMCSA's drug clearinghouse, is showing that drivers may be trying to cheat the urine tests at a relatively high rate. Executives from large carriers and carrier trade groups say they would adopt hair testing almost immediately if it were to become the industry standard. Representatives from Schneider National say they have a nearly 10-fold increase in positive tests when doing hair testing over urinalysis testing, and they believe they are missing the chronic drug users by only doing urine testing. However, there is some pushback from owner-operators and smaller fleets. Commented by Louis Pugh, the vice president of the Owner-Operators Independent Drivers Association. He says, nobody wants people using drugs on the highway, of course, but unfortunately a drug can last up to 6 months in someone's hair. He questioned, so was the problem 6 months ago, or is it a problem now? That's why he believes the urine testing is the way to go.
I feel what Mr. Pugh is talking about, right?
Yeah, I mean,
because the intention is to keep people that are under influence from driving right now. Does the hair test actually give you that real-time information, or is it merely to see are they chronic or did they use drugs yesterday or a week ago?
Andrew?
Well, I do believe there is a spectrum there where you can tell somewhat on the timely basis on when it was used, but the problem there is that you still can fail the test even though you haven't used any drugs in many months, and that's what Mr. Pugh's pointing towards, is that someone could have used a drug 6 or 8 months ago and it's still in their system now, even though they've been clean for some time, been able to drive and do everything correctly. So, the difficulty there is that timeliness issue.
Yeah, because, they don't care if the person was drunk yesterday.
No.
They care if they're under the influence right now. So a lot of this hair follicle is for illegal drug and abuse, chronic substance abuse, which can definitely affect, your ability to perform the job. But so can running a marathon yesterday.
Well, it can. I'm wondering if that's the hair follicle testing, is that for the entire drug panel, like cocaine and barbiturates and things like that?
I don't know that we know enough about that to really make a definitive decision on it. But if it actually improves your ability to to avoid people masking a urine sample right now to make sure they're safe driving their truck right this second. I'm all for it completely. But if it's merely to see if they were using drugs 2 weeks ago or 3 weeks ago, I'm kind of on the fence on that type of stuff.
And it's a conflict that's been going on for, as Andrew was saying, for years, right? For years, and it's kind of the enterprise carriers, the larger carriers are for it. The owner-operators, not so much for it.
Right.
And it's all about, hiring and retention and those type of issues. Yeah,
and I would think that, even if someone is not taking drugs while they're driving, et cetera, if they're a chronic drug user, right? There's got to be some statistics out there as to whether they're actually a safe driver more often or less often than someone who's not.
We've seen a couple stories of chronic users getting into fatality crashes in the last 2 or 3 weeks.
Sure.
Flipping over to YRC. Good news for YRC again, or at least the announcement of next day service for LTL.
Yeah, Kevin, not to be outdone by expansion announcements from competitors, LTL carrier YRC is expanding its regional next day service. The Chief Network Officer, Scott Ware, said through regional next day service, our customers in Texas and across the Mid-South can access just-in-time scheduling that offers benefits of lowered inventory cost and fewer supply chain disruptions. Ware said the service has been very successful since it launched in Texas last fall. The service now includes 11 terminals in that Texas initial launch and now is going to expand to 6 new states, including Arkansas, Missouri, Oklahoma, Louisiana, Tennessee, and Mississippi. The carrier expects the service to provide faster transit times with lower damages due to reduced touch points. YRC is trying to turn things around after receiving that $700 million Treasury loan. The company has also said they're ready to embark on a $400 million fleet upgrade in the coming months. This move from YRC is just another in a long string of LTL expansions. Just yesterday, FedEx announced that its freight division was opening a 166-door facility in Laredo. Old Dominion has already opened 9 new terminals in 2020, and now Forward Air is going to move into the LTL space by providing traditional LTL services out of Savannah. Truly, YRC is looking to use that government money to keep up with competition. They're spending it as fast as they got it.
Yeah, it's an interesting development. It's a difficult thing. I spent quite a bit of time in LTL, and developing something like this. And they said they have tremendous success in 11 terminals, I think, in Texas.
Yes.
Right. So I mean, when you're talking about LTL, you're talking about an hour delay can mean a day of service. Right, because you're talking about this hub and spoke network that is moving around. This is not a simple thing to do, and it needs to be rolled out strategically, and it needs to be sold at the same time it's being rolled out, because LTL, you need density or cube utilization, I should say, on those trailers to move them. That's all about it. And they've got to cut. If you're doing overnight regional type of deliveries, that trailer's got to cut at a specific time. And so you run into danger of not having full trailers moving back and forth. You're also got heavy investment in these large break bulks, like these 11 terminals and many more, all feed into, like, say, their Dallas break bulk, where it's all deconsolidated and then consolidated onto another trailer, moving to another break bulk, say in the Northeast, and then moving to those little the pilot or satellite terminals for then delivery. And that's happening all the time. Now you're going to skip those break bulks, and you've got this investment in these break bulk that's going to see less volume and move these things direct from terminal to terminal. I would imagine it's not an easy thing to do. It can be done, and I hope they're successful in doing it. But it is who was it? Jason Bergman said, their chief customer officer. It's a strategic investment, and it's a difficult investment to make. It's not an easy thing to do. There's a lot to it.
It does, and it looks like all across the LTL landscape that everyone's upping their game. Right. Andrew mentioned Old Dominion's opened 9 terminals so far in 2020. Forward Air is moving more into the space. And FedEx, more cross-border LTL with a terminal in Laredo, Texas. So you're seeing everyone up in the game. So it'll be interesting to see the LTL landscape over the next few years going forward.
It is, and it'll be, there's a lot of technology out there. There's a lot better track and tracing than back in my day when I was there. Wish we had it at that time to understand what is actually being picked up at this moment in those pickup and delivery units that are running around the city before it even comes back to the terminal, so you could better plan those moves and consolidate and make what we would call a head load, which would be like, say, half a trailer that was moving to a specific region or a specific other terminal in the United States. You can plan that stuff out a little bit better with this technology, and time is ripe to try and do something like this, but very difficult thing to do.
It is. It definitely is. Moving on to the Travel Centers of America reported earnings, and they were pretty good, but didn't quite meet expectations. Isn't that right, Andrew?
Yeah, a mixed bag of results for Travel Centers of America, and this comes after reopening some of its restaurants. They are now in the process of closing down some of those restaurants due to the recent increase in COVID-19 infections in several states. Management said that approximately half of their restaurants are currently open, with many offering a limited menu. They said they haven't decided whether these closures are going to be permanent, but they do note that the pandemic has offered them an opportunity to assess their dining plans. And I wouldn't be surprised if you come out of this with the TA centers having smaller menus or having far different offerings. They're going to look for new partnerships. But on to the Q2 earnings, they did announce, and EPS came in slightly below expectations at 59 cents, but this is 4x the Q2 2019 number, so much better than last year. This all happened while total revenue was down nearly 40%. The company was able to be really disciplined in cost control through furloughs and through management improvements. But much of the drawdown in revenue came on with the very little profit margin gas revenue, which was down nearly 50% due to not only lower gas prices, but lower consumer demand from the pandemic. And the stock market has been very happy with these results. TA is now up over 20% over the last 7 days.
Smells like an opportunity for food trucks.
Food trucks, it definitely does. And one of the surprising things, I guess it wasn't surprising, it's just good to know with a lagging effect, is that gasoline prices, every source that we go to kind of paints the same picture of early in certainly early in the second quarter, of gasoline, fuel, diesel being dramatically down.
Oh, yeah.
And it was down,
absolutely.
Was it 29.9%, Andrew?
Yeah, gasoline or fuel revenue was down almost 50% for the quarter.
Yeah. And then you had the reopenings of the restaurants that got about halfway to capacity, and now they're pulling back a little bit. But I think that the smaller menus, you see that everywhere. And I think that in the long term will help all restaurants really be more profitable by limiting
it's kind of like we talked about on Tuesday. They're they're eliminating the number of their SKUs to gain profits.
That's exactly right.
It makes perfect sense. Mm-hmm. Is it a case of like we're seeing this, second wave, whatever? I think it's a continuing ripple across the United States myself, but I'm not a scientist. Is it a case of trying to open too quick, too soon?
I
don't know. I mean, I think it probably is. What do you think, Andrew?
Oh, I think the question was it a case of reopening too soon?
Yes.
Yeah.
Yes, I mean, I think that's what the pandemic experts are saying, that we weren't really able to flatten that curve to begin with, and I think we reopened a little too soon, and I think TA is taking part in that, and they're trying to do their best to curb the spread.
Yeah, I guess the good news for them is just it's not permanently closed. They're pulling back a little bit and assessing the situation.
Yeah, they're pulling back, but I think those the limiting of the menus, I think that's going to be one of the long-term effects that come out of this pandemic, is that all restaurants will shrink their menus. So you get the same feeling, Andrew?
Yeah, I do. I mean, that's something Seth Holm and I have talked about the structural cost has really changed for a restaurant moving forward. I mean, they're going to be doing a lot more delivery, which means lower margins. They're going to be eating in. So yes, I think that restaurants are going to slim down. You're going to see less servers, less bartenders, less management, and with that will come smaller menus. I think you're onto something, Kevin.
Yeah, efficiency, cost cutting.
Yeah. Yeah, let's move on to the last headline. It's another, not really earnings results, but results report from the Port Authority in Jersey, and kind of what action they saw in the second quarter.
Yeah, Kevin, the Port Authority of New York and New Jersey did not sugarcoat their news. The headline in its press release read, COVID-19 related volume decline causes single worst quarter on record. During that second quarter between March and June, the Port Authority's revenue miss totaled nearly $800 million. That's about $200 million per month below their budget. Chairman Kevin O'Toole called this an unprecedented number. The Port Authority said, based on the results of the past 6 months, and as well as its forecast, it projects a $3 billion revenue loss for the 24 months ending in March 2022, excuse me. The authority is responsible for all land, air, and sea transportation infrastructure and operations. Some numbers for you here. Through mid-April, their air traffic had fallen 98%. The path commuter rail traffic had fallen 94%, and auto traffic through the tunnels had fallen 64%. So the climb back to normality is going to be long and slow for the Port Authority. This is one reason why the authority has requested $3 billion from the federal government to provide and to avoid the impact of sharp revenue losses to the agency's critically important capital construction projects.
And we all knew this was going on, but it's still staggering to see these numbers. Through mid-April, air traffic had fallen 98%. Path traffic, from like Hoboken and Jersey City into Manhattan and back, fell 94%. I mean, that's like, and I used to take those trains all the time. And to just imagine that traffic fell 94% is...
Yeah, well, yeah. I mean, we're talking rail, subway, all that type of thing. Ferries,
and I'm sure the ferries as well. Yeah,
and then you got the bridge tolls, tunnel tolls, et cetera, that all crushed.
64%.
Down 64%. Yeah, I mean, when you first see the headline, you think, "Oh man, the port is dying." Well, the Port Authority controls all of these other. It's the airport, it's the rail, it's the ferries, it's the tunnels, it's the bridges, it's all the thing. Although in that article, they did speak to maritime traffic. As well, and they got hit. I think they believe the hardest was in May, but they've seen blank sailing starting to diminish a little bit and starting to come back.
Yeah, I don't think the port's
what we're seeing as well.
As dramatically.
It got hit pretty good, they said, but this was really the main killer. Was these things right here that really caused that. So it's very interesting.
It is very interesting, and with that, let's move on to the freight markets and the trucking, full truckload freight market with our very own Zach Strickland, Director of Freight Market Intelligence here at FreightWaves.
Hey guys, so I go on vacation and nothing has much changed in terms of capacity in the market, except for the fact that it continues to drive. The market continues to drive towards a much tighter environment. Volumes, of course, are increasing significantly. They're climbing every single day, very steadily so. And something that did change slightly is the fact that here in the last day or so, van rejection rates have moved a little bit more horizontal, whereas reefer rejection rates have taken a little bit more of an acceleration higher over the last little bit. They've kind of been moving in lockstep here over the last month or so. Really, van made a significant increase in June and really caught up to reefer rejection rates through that. Very different from the market that we saw in March, where reefer rejections really just drove a lot of that tightness. Significant increase in rejection rates there, and van kind of obviously tightened significantly, but not near the pace that reefer did. And right now, reefer's starting to pick back up again. But Kevin, this might interest you, I'm sure. Produce season is not necessarily the thing that's showing the reason for tightening. We're seeing these agricultural spot rate movements coming off the West Coast actually start to decline slightly here in the last week or so. Especially from Northern California, where rates have been steadily increasing to horizontal here over the last few weeks. It looks like we may have jumped over the hump on produce season, as you so to speak. But that being said, we're seeing significant reefer capacity tightness, and again, the divergence from flatbed rejections is even more significant, as that sector has still yet to come back online, with flatbed rejection rates still hovering around 6%, with just a slight uptick here in the last few days.
Yeah, Anthony and I were talking about that yesterday on FreightWaves Now. We did a shipper segment, and we talked about industrial production or the PMI, I believe. and flatbed rejection levels. And I'm sitting here looking at Sonar right now, and we have basically van and reefer rejection levels combined up almost 22%, which is like 1 out of every 5 loads are being rejected. But you flip back to the flatbed market, and it's below 6%, and it's just I'm not quite sure what to make of that.
Yeah, I think a lot of that has to do with the fact that, we're just starting to see some of those production lines come back online. Oil and gas, a large contributor to the flatbed market, has really been subdued. It's starting to come back, and it's a long way away from where it was when we started this whole process, whereas like reefer and van actually had a lot of those commodities already in process. They were already being, you can transfer those between warehouses. There's a lot of other movements you can have. Whereas on the flatbed side, you're talking about a lot more raw materials, pre-production items that simply weren't needed yet. A lot of shippers out there, a lot of companies out there trying to figure out exactly what was needed before they started turning those assembly lines back on. And obviously, that takes a lot of time to kind of sort through the haze, the fog of war, if you think about it that way. And it's taken a lot more time, but we are starting to see some of that stuff really come back. If you're looking at rail carload volumes and things like that, we're starting to see the very early stages of a lot of those production volumes start to creep back up. So that could, again, considering that flatbed rejection rates are down around 6% and the other two primary modes are up in the 20s, it could only tighten things here in the next month or so.
Yeah, solid point. I mean, I was going to say the flatbed market is heavily skewed towards construction and oil and gas, which is just now really starting to move again, and industrials, obviously, which is just moving up now. But I find it interesting as well, Zach. We haven't spent a whole lot of time talking about it. Is the wait times or detention they're gone. I mean, relatively speaking, they're way down in just about every single market. Are you seeing the same thing, Zach?
Yeah. We were talking about this earlier today. Wait times, again, that period of time that it takes for, you bump the dock and you have to sit there and wait, or, you're sitting around the dock waiting to get backed up into it, et cetera. That's a huge point of contention between carriers and shippers historically. Carriers have detention times, which are historically difficult to enforce and charge because the lack of tracking, and obviously there's definition issues on what is truly the shipper's fault for detention, et cetera. So this has been one of the biggest hurdles for carriers and shippers to overcome in probably the last, ever since I've been in the industry. And now with tender rejection rates increasing at the rate that we're seeing, I think shippers are a little bit more cognizant of the fact that they don't really want to disrupt. They don't have as much leverage as they had in the years past. We saw this happen in 2018. Wait times plummeted as rejection rates increased. Again, shippers don't want to upset the carriers too much to make sure that they hold a nice place in their routing guides. They're not going to have that second and third tier option sitting there waiting to gobble it up as they did in the past. So I think this is a natural progression for seeing when you do see capacity tighten to the places that it's going right now. Wait times tend to reduce, but also there could be another aspect of operational efficiency as well as just the fact that they need to move this freight as fast as possible because of the increasing demand.
Yeah, I'm sitting here looking at wait times, and they've plunged about a third since March, which is amazing, from above 150 minutes to 108 minutes as of today, which is a huge plunge on those.
Oh yeah, it's unbelievable, and I mean, as you were saying, Zach, I really think that it's a case again of. When you see the outbound tender rejection spike, you usually start to see detention start to come down. As you said, Zach, you've got these shippers in this particular moment right now really trying to take care of their carriers as well. But is this not also a result of efficiencies and technology, drop and hook, that type of thing, taking care of those drivers being accelerated? Another area where we're seeing efficiency and movement towards new technology that's going to make things better being accelerated because of COVID-19, because you've also got that lack of wanting or the desire to limit the interaction between warehouse workers, dockhouse workers, and drivers, right?
Yeah, I mean, I obviously hope that that's one of the biggest driving factors, but especially with the outbreak really pushing that reliance on technology and improving the ability for people to keep their social distance. And that, again, since this wait time index is also based off of geofencing activity, we could simply be seeing the fact that a lot of those trucks are not being allowed to enter some of these markets as quickly as possible as they keep their distances as well. So they could have timing issues and things like that built in. But I would love to think that a lot of the improvements in technology and efficiency can be seen in this index and some of the data that we're looking at right now, just because I would hope that that's the way that everybody would go. But at the same time, I can't definitively say that that's 100% of the case.
That's all right. Well, thank you very much for that recap of the freight market, and we'll see you next Tuesday for another update on what's going on truckload. Hopefully those load volumes continue to ramp up, and that's good for all of us.
Hopefully the economy keeps steaming along, and we keep going through this. We get the virus under control, and get back to opening things up and getting back to normal.
I know. And one of those big indicators of how the economy is going is released every Thursday morning, and this Thursday morning is no exception. So we have Anthony Smith, our chief economist here at FreightWaves, here to discuss initial jobless claims. What was the number today, Anthony?
That's right, Kevin. We got another update for the initial jobless claims on this Thursday morning, and we saw was that there was a 1.186 million increase or total for the week. And so this is a decline from the last week's numbers. And so it's showing that there has been downward movement after 2 weeks of increases. And so this is something of a positive sign, of course, because we always want to see that number coming down. One of the big things to note is that this is really, really still far above any of the previous historic levels. We're looking at this week's jobless claims. Continuing claims also declined, so this has a 2-week lag to it. And so we're seeing that these are both moving down in the same direction. So this is, again, a positive sign, but this is getting clouded a little bit by the expiration of those bonus benefits that were put out during the mid-March timeframe. And so even though this is the lowest level that we've seen for jobs claims since mid-March, this is still a far way to go for unemployment and for many Americans throughout the country.
So were they significant drops, Anthony? 1.186 million was last week. Was it like 1.38 or something like that?
This was a significant drop. I think the more significant drop was probably for the continuing claims. It's down to 16.1 million. And so this is a drop of well over 400,000 on a week-to-week basis. Again, continuing claims has a 2-week lag. But I think when we're looking at those 2 weeks of increases, it kind of lends to that there was some slowing of momentum within the economy as cases started to increase throughout the country. I think as we're starting to see the lack of benefits being able to be provided for many Americans in the coming weeks, that may reduce incentives for many people that would have previously been applying for some of these unemployment benefits. One of the releases that I'm really looking forward to in the upcoming weeks is next week, actually, the job openings report. And so that's going to reveal what kind of openings and opportunities are going to be available for many Americans throughout the country. There's also going to be the official unemployment monthly number, that's coming out tomorrow, actually. And so I'm hoping to see something under 10%, but it's looking like it'll likely be somewhere around that 10% mark. So as long as we're starting to see that constant continuing decline, I think that's a step in the right direction. But still, there are a lot of uncertainties as, of course, we're seeing many professions being completely changed, going from layoffs to permanently just kind of being terminated altogether. So I think when we're looking at this employment environment, there's going to be a lot of transitionings that need to happen for many Americans to look to replace that employment income that they had for their household previously in a different way or a different venue or a different industry altogether.
Yeah, so the CARES Act, the pandemic relief, that ran out. The federal assistance, I think it was $600 extra a week in unemployment. I saw headlines today that they're still far apart from a new deal that could or could not be accurate. Who knows? It's a very fluid situation, changes all the time, Anthony. What can we expect the economy to do once we, that ended, I think, a week ago or 2 weeks ago, but as we get 3, 4, 5 weeks down the line, what are your expectations for, say, consumer confidence?
I think without a doubt, consumer confidence is going to take a hit. I think it already has. The latest consumer confidence index showed that near term and long term both took a hit for consumers throughout the country. I think when we're looking at the, as you mentioned, the CARES Act expiring and the increasing of cases throughout the country really lent a lot of uncertainty for many Americans. And I think that's likely going to be the sentiment moving forward. We're looking at reduced benefits going forward. I think there's going to be an obvious, a notable decline in some consumer spending potentially, with less money in a lot of people's pockets. Definitely going to be looking towards some of those eviction rates. Unfortunately, I think that's going to be a reality for many throughout the country. I think that's going to really hit a lot of folks hard if there aren't any kind of government mandates or local mandates to kind of protect those from being evicted. So I think that's going to hit a lot of Americans hard. And in addition to those who are the property owners, I think they're also going to be in a tight position as well if they're property owners, investment owners, and they're not getting their those payments on those monthly bases. I think they're going to have to do a lot of work with some of these banks that may not have that type of protection in place. And so I think when we're looking around, everyone's going to be in a really tight position moving forward if we're not seeing any type of relief aid put in place anytime soon. As you mentioned, a lot of odds on kind of trying to find a settle middle point for this relief package or potential relief package. I think the likeliest thing might be another $1,200 stimulus check, but it's still yet to be seen what kind of week-to-week monthly benefit would be put in place, if any.
Yeah, I think that's the biggest bone of contention is the unemployment assistance.
I think it is too. And I think one of the more, of course, the most interesting data point comes out tomorrow, right? And Anthony was talking about just a second ago is unemployment rate, the monthly unemployment rate, as it is reliable, but as it's hard to catch big moves and big swings, right, Anthony, in that monthly. Anthony?
That's right. So when we're looking at that monthly level, it's hard to see some of the more near-term movements. We're looking at the jobless claims on a week-to-week basis. That's really going to capture what's happening right now. I chatted with Andrew Cox earlier today, and we got to talk about how there's such a different economic environment on a month-to-month basis, and there's so much that's happening. And so I think when we're looking at the jobless claims, that's really going to give us our closest, nearest term look, as opposed to what's happening on a monthly level. Of course, there's going to be some insights gleaned from these monthly reports on an industry basis to kind of really see where payrolls are for different industries and different businesses. Of course, expecting a lot of services to get hit hard in the upcoming payroll report. But definitely looking forward to some of the insights that are going to be in the upcoming unemployment report. And of course, hoping to see a higher number for those job openings for many Americans to have more opportunities to find employment and, again, provide for their household.
Thank you very much for those economic insights, Anthony, and we will be glued in tomorrow morning for the unemployment number, and we will get another update on the economy on Tuesday's show when we're back for the Midday Market update. It's always fascinating.
Yeah, right? It's going to be interesting. I was reading, they promise by the end of this week they'll have something done, right? Well, I hope they do, because the whole economy is kind of sitting here waiting for something to happen, right? There's people forging ahead. The requests are getting aggressive to hire people. Have you noticed this?
The what?
The employers trying to get people into work are starting to get aggressive. There's signs out all over the place. We're hiring, we're hiring, we're hiring. They're hitting social media like crazy. I had a couple people mention to me yesterday, have you noticed that you're getting all these things constantly? We're hiring and trying to advertise work for us, trying to get them. And that's one of the biggest bone of contentions that's in this right now is that unemployment, right? Yes. Mm-hmm. You see people who are, they're making more or they're better off not coming to work. Plus, they're safer. not coming to work, obviously, at this time right now. So,
big thing as well. And we have Kyle Van Artsen, late to the party, but I'm here, boys. And apologies, I was late getting back to you. And he also says, glad to hear the food truck has graduated from the Roach Coach days.
Oh, I think the Roach Coaches are probably still out there.
Yeah, I imagine they are.
But I do remember those days when it was very prevalent.
They do. Yeah.
But right now we have our first guest, Mr. Sherman Barnes II, head of sales and marketing at Trio Trucking Incorporated. Sherman, how are you, my friend?
Doing well. How are you guys doing?
Doing great, man. Doing great. So, hey, second time on FreightWaves TV with us. So let's, can you give people a little bit of background about yourself and what you guys are doing there at Trio Trucking?
Yeah, so we're a 40-year-old company. We specialize in intermodal and truckload services. We're a minority-owned company, but we're a transportation company first that just happens to be a minority company. So we're working with larger accounts like Procter & Gamble, J.M. Smuckers, J&J, Walmart, to name a few. So excited to be here and have a conversation with you guys.
Excellent. We're glad that you're here as well. So you're in the truckload and you're in the intermodal side as well. So what are you seeing in the marketplace in your verticals there? You mentioned some big dogs that you guys work with there. What are you guys seeing?
So from our perspective, we're seeing more volume, which is exciting. Obviously, I follow FreightWaves and Sonar and all of those things, and so I know a lot of, people are seeing upticks in volume, and we're no different from an intermodal perspective as well as from a truckload perspective. Some of the customers that we deal with, obviously, with the names that I mentioned, tissue, paper products, sanitizers, things like that are really doing well. Also, an interesting segment that's doing a lot of volume right now that you wouldn't think about it is plastic companies, because as our kids, I'm here in Dallas, Texas, and the kids are going back to school. So they have those plastic partitions, if you will, that school districts and whatnot are having to buy. So we're seeing upticks and things like that. So with that uptick in volume, we're also seeing rates move upward as well. There are some customers that are fighting the pricing. But there are a lot that is starting to stick, and that's not only just for my company. That's also for different companies that I talk to or people that work within different companies in the transportation world. They're seeing their customers, that didn't accept price increases before, being willing to accept those price increases just because of the supply and demand dynamic that's going on right now. So I think routing guides, some of them are staying sort of intact, but they're starting to break apart. I talked to a customer fairly recently who had an RFP, and before the implementation date even transpired, that person was saying, hey, I'm getting calls and saying those rates are no longer good. So it's definitely happening right now.
Yeah, it definitely is. It's a roller coaster. 2020 has accelerated the cyclical nature of trucking. We've gone through about 2 or 3 cycles already in 2020. We're just coming into the 8th month in there. Sherman, are you seeing any industries out there that are lagging behind? That the volumes really aren't up, that the pricing's still soft?
With the people that we deal with, no. No. I mean, all the companies that I deal with, they're dealing with items that are really doing well right now. So not from my perspective, but I would imagine, some industries that are hard hit, maybe ones that are dealing with hospitality, for example, and, airlines and whatnot. That's what I would imagine.
Yeah, I would agree with that as well. Definitely. Sherman, a question for you, though, is how much capacity, I guess, or maybe not how much, but what's your thoughts on the mom and pops? You've got these mom and pops, these owner operators that are sitting out of the game right now, right? They got their loans. They're sitting out of the game right now. Is that a significant driver in the tender rejections and the tightness in the capacity that we're seeing here, and kind of what do you see the effects on those mom and pops of this environment that's going on right now?
So that's a good question. So there's an article that I shared recently by James Jaliet, I guess that's how you say it, called Haul More, Charge Less. And some of the things that it was calling out, which was that the number of truck postings on major load boards has fallen off since April. Week over week trend continued into July. That's something that we're definitely seeing. And also the article talked about how the PPP money has provided liquidity for some trucking companies to say, hey, listen, I'm not going to move unless the rates are where they need to be at. So that's something that we're definitely seeing. I mean, we could move from our brokerage perspective. So I'm asset on the truckload side, we're IMC on the intermodal side, but we also have a brokerage component as well. And from a brokerage component, that uptick in volume, we could hypothetically move more, but there are quite a few small mom and pop companies, that will comprise the carrier base for freight brokerage they're laying dormant and are not moving. So some of them were telling me, hey, it was summertime, so I'm taking off to spend time with my family. Historically, I'm not able to do that. Just to be quite frank, with the unemployment checks at $600 a week, there's little incentive for a driver that's making perhaps $44K to go out and work to bring home the same amount, even after taxes or whatnot, and expenses. They can stay home, fish, do whatever they may need to do during this time and spend more time with their children. So, there is capacity that's laying dormant in that mom and pop spots from what I'm seeing.
How about on the company driver spot? There's this environment right now, this bull market of transportation that we're going through right now. How is driver hiring, retention? Has that changed, or is it following the normal historical norms?
To me, it's finding drivers is always a challenge. Mm-hmm. I think it's honestly going to continue to be. If you made me say, is it up or is it a little bit harder or a little bit less harder? I say it's a little bit harder right now. Drivers talk, as you know, on the load boards and Facebook groups and whatnot. And if it's not deemed to be a profitable occupation right now, based on the amount of miles that they're able to run or whatnot, I mean, it can be a little bit more challenging. So I say it's a little bit harder right now than it is historically, from my perspective.
Gotcha. Sherman, we were talking earlier with Zach Strickland, excuse me, our director of freight market intelligence. We were talking about the drop in detention times. Right, and talking about how shippers are really, they're taking care of their contracted carriers. They're taking care of those, trying to get them turned as well. Are you seeing those detention times come down? And what's your opinion on that? Is it just them taking better care, or is there just better efficiencies in the technology of making those turns and more drop and hook?
I think that it's better efficiencies. Customers have learned, we've been talking about shipper choice at, various companies for years and years. So I do think that they're learning, drivers being able to utilize, again, even things as simple as a restroom or having a waiting area for the driver. So I do think it's a technological, component to it, as well as just the, shipper of choice behavior that has been in place. But also, with the increased volume, they got to get people in and out a little bit more quicker. So we're definitely seeing less detention as well.
Sherman, are your expectations for the remainder of 2020 that the freight is going to be this strong, or do you think that will peak soon and maybe come back, pull back a little bit? What are your expectations for the rest of 2020?
My expectations, I think it's going to be good. I'm pretty excited about, Q3, Q4. If you ever watch CNBC, there's a buy sell and a sell side, right? A buy side and a sell side. So I'm definitely, excited about Q3 and Q4 from what I'm seeing. Obviously the election's a little bit weird, right? It's going to be some components there to determine what's going on. But at the end of the day, I am excited about what I'm seeing for the rest of the year.
That's fantastic.
Excellent stuff, Sherman. Thank you so much. How do people reach out and learn more about yourself and Trio Trucking?
Well, you can reach out to me directly. Our website is, www.trioenterprises.com, or you can reach out to me. I'll just put my Can I put my number on here? It's fine, I guess, right? 404-406-4454. Once again, that's 404-406-4454. I'd love to hear from you.
Excellent stuff.
Fantastic.
Thank you so much, Sherman. You have a great day and a great weekend, my friend.
All right, you too. Take care.
Always interesting.
Yeah, good insights.
Sherman always has really good insights to bring to the table about the industries that he serves and what he's seeing out in the market.
Yeah, and he's very bullish.
He is very bullish. So he's buy.
He's buying. If you're selling, Nate's buying. Or Sherman's buying.
Yeah.
Sorry, Nate is our next guy.
Nate is our next guest. But Sherman is selling.
Maybe he might be buying too.
He's a buyer because he's selling. Right?
There you go.
Exactly.
There you go. Absolutely.
We're joined by our next guest, Nate Robert, who's co-founder of Baton. How are you doing today, Nate?
Doing great. And yes, on my side, I am doing the selling, but I agree with Sherman's sentiment for sure.
Yeah, bull market continued.
Exactly. Yes.
Perfect.
Awesome stuff. Hey, welcome to the show, Nate. Thanks for coming on, my friend.
Very much.
Why don't you tell our audience a little bit about Baton, how you guys got started and what you do?
Yeah, so Baton is a technology company out of San Francisco, and our goal is to eliminate waste in the trucking industry. So I know we're going to talk some about detention today, which is the biggest cause of waste in trucking. And really from a higher level, it's the largest unsolved problem in freight across the board. And with Baton, our mission is to divide long-haul trucking into two segments. So a final mile component that we run with our trucks, and a highway-only segment that is for long-haul drivers to do what they do best, which is churning out miles. And we do this with a tech-enabled network of drop zones where long-haul drivers come in, drop and hook right off the highway, and then we use a network of local fleets to do the local P&D.
So they're power only, and they're moving back and forth from. We called them line haul drop yards right there, like on the turnpike when I was in LTL back in the day across Ohio, et cetera. So that's how you guys. Does this not set you up for future technology as well?
Yes, absolutely. So if you think about the future, the main thing on people's minds for the future is autonomy. And with autonomy, it's really not a question of when it'll happen; it's a question of where it will happen first. And it's going to happen first on highway-only segments. So we're setting up this nationwide infrastructure right now that in the future, whether that's 5 years or 10 years down the road, autonomous vehicles can plug in, do the highway-only segment, drop off at our drop zones or transfer hubs is the word used in the autonomous space. And then we'll use our network of local fleets with human drivers to continue doing the local P&D.
And that slims down detention because detention, as we've talked about a few times, Nate, is not about sitting at the dock waiting to get loaded and unloaded. There's actually a few different there's more segments to that. Delays, going to dropping in one place, picking up in another. Can you give some color on that?
Yeah, absolutely. So when we think about We think about waste as like three categories of dwell. So there's the typical category of dwell, which is just detention. It's dwell at the warehouse. It's the worst. It's the easiest to measure though, and a lot of carriers have some things in place to somewhat mitigate the bad effects of detention. The other two categories though are in transit dwell, which is any slack time that you have to build into transit when you're going from, for example, Dallas to LA, to make sure that you hit that 8 a.m. appointment, you have to build in some slack time, and that ends up being wasted time. And then the third category is inter-appointment dwell, which is any time between finishing one appointment for a delivery and starting your next appointment for your next pick. So unless you have 100% perfect scheduling, you're going to have some wasted time in there as well.
So you're doing it on both ends. You're doing the pickup and the delivery on this final mile?
Yeah. So we say the first and final mile. We do both ends. Yeah.
Yeah. All right. That makes perfect sense. So let's talk about detention a little bit and how it relates to driver retention as well. So, I would imagine you guys are solving for that type of situation as well, right?
Yes, absolutely. So that's the other huge component to this. I don't think this is a surprise to anyone, but we've done a bunch of a series of interviews with drivers, and detention is consistently the number one complaint that drivers have about their jobs. If you're a long haul driver and you're getting paid per mile, the worst thing in the world is being stuck at a warehouse, not moving and not making money. And this has been exacerbated with hours of service because back several years ago, if you were stuck at a warehouse for a couple hours, you could just drive later into the night to try and make up the time and make up the miles. But now you can't do that because you're stuck at the warehouse and you're working, but you're not making money. You're on the clock, but you're not making money. So detention is one of, if not the biggest contributing factors towards driver turnover. And anecdotally, carriers that reduce detention for drivers have the lowest turnover rates.
Have carriers really started rethinking detention and really pursuing new options and new solutions, especially since the pandemic? Has that really changed their course of action?
So it's interesting how carriers have thought about detention since the pandemic started. So like everybody's always thinking about detention, but in the last month in particular, I mean, we've been in the hottest freight market in history, and trucking companies are doing everything they can to keep up demand for two reasons. They don't want to turn down freight from existing customers, because when the market shifts, those customers will have power, and they'll give freight back to the trucking companies that treated them well right now. So this is loyalty begets loyalty. On the second piece, like freight is just going begging on the spot market right now at ridiculous rates. I mean, the DAT average van spot rate is above $2 right now. Some freight on the spot market is at much higher rates than that. And so carriers obviously want to grab this high margin freight, but beyond this, from a strategic perspective, if carriers can add more capacity right now, they can capture market share away from competitors and be in a better position when the market does cool down. So all of this to say, the opportunity cost of having a tractor stuck in detention is massive right now. So it's always been important to keep trucks off on the road, but right now it's an absolute imperative. And yeah, carriers are doing anything they can to stay out of detention and keep moving freight.
Yeah, and there's always the negotiated free time, right?
Oh, yes.
So,
yes, that's always a fun process.
Some customers, 2 hours of my day not making money, I'll just give that up to be able to haul your freight, right?
I know, right?
So we were talking about detention times. Obviously, you were listening, and obviously it's something you guys are solving for from the carrier side, but. So the solution to a lot of this and some of that freight that is very attractive to carriers is, if you've got the assets, is drop and hook, right?
Yep.
But there's a lot of shippers that can't participate in that type of situation, whether it be at all their locations or some of their locations, because they just don't have the room, right? So can you speak to that a little bit?
Yeah, absolutely. So. For shippers like Walmart and Target that do a lot of drop and hook freight, I mean, those are places where you see the lowest wait times and the lowest detention. At Baton, we primarily sell to carriers, but we do actually have shipper customers as well. And it's for the exact scenario that you described, where if a shipper doesn't have enough room on their property to do drop and hook, there's actually a lot of downsides for shippers as well of having to do live loads. They get more congestion. It's harder for them to optimize their dock labor. Their appointments get all jumbled around. So, and also the free hours that you were talking about earlier, even if they're unloading in less than 2 hours, like all of this time, extra time gets baked into their transportation rates that they have to pay.
Right.
So they are also looking for solutions where they can work with someone like Baton, where we offer off-prem drop and hook, a couple miles away from their facility, and then we'll figure out all of the local P&D to basically use, effectively like long-range yard jockeys to shuttle back and forth from our facility to the shipper facility, so that from their perspective, it's just like it's all drop and hook. We've converted all on-prem live loads to off-prem drop and hook.
Very interesting. It's always very interesting. Where are you guys live at doing first and final miles delivery right now?
Yep. So right now, our goal is to build a nationwide network of these drop zones, as we call them. Currently, we're live in Los Angeles, both Inland Empire and Western LA as well, and Atlanta.
Awesome.
Gotcha. Now, we've had several autonomous vehicle manufacturers, well, whether it's vehicles or actually software and the control, et cetera, trying to set up these freight networks, et cetera. Are you working with any of those guys, or are you trying to work with those people as a future? Like we spoke about before, you're solving major issues right now. I'm not trying to discount that at all, but it seems to pair very, very well with the efforts of some other companies who are trying to set up these autonomous networks.
Yep. Yeah, absolutely. We've spoken with almost all of the major autonomous vehicle manufacturers at this point, and I think based on timelines with them, we're speaking with a couple about working on some initial pilots where we help them with the transfer hub infrastructure for them to start testing their trucks in the real world. So that's definitely something that's forefront in our minds, even if it's 5 to 10 years from now when they become ubiquitous. It's a big focus for us and strategically right now.
Right.
It is definitely. I mean, that's where autonomous is going right now. You have
even as they're testing out markets right now, you've got opportunity right there, right? Because they're going to test on certain lanes, and there you go. Baton fits right there.
Fits in perfectly with all that. Well, thank you very much for your time today, Nate. How can our audience learn more about Baton?
Yeah, so you can check out our website at www.baton.io, or feel free to shoot us an email at info@baton.io.
Thanks again for your time today, Nate.
Excellent stuff. Thank you, Nate.
And the Carrier Summit coming up on August 19th and 20th. I do a fireside chat with Nate and his partner over at Baton, Andrew Burbrick.
Awesome.
When we talk about detention,
I'll be sure to tune in.
Expand on this conversation.
I think it's brilliant. I think they're positioned perfectly, I think it's. I think it's great. I find it fascinating.
I first heard about it that they were in here at Freight Alley about a year ago.
Right.
And they came in and we started talking about it. It's like we were kind of thinking, if you're doing trailer pools, it makes sense to do what they were doing, what they were going to do, and I'm so glad it's worked out for them so far.
Speaking of Carrier Summit.
Speaking of.
Yes. So the FreightWaves and Seat My Trucks are excited to present the Carrier Summit on recruiting, retention, regulation, operational efficiency, and maintenance. Expect to hear from trailblazing trucking pioneers who have impacted the way we do business today and the way we will do it tomorrow. Get the latest updates on how truckload carriers are adapting to the new world we live in. You'll hear about driver management and training in a remote working environment, recruiting and minimizing turnover strategies, mergers and acquisition activity, and reducing downtime efforts. It's a day and a half this time, right?
It is a day and a half.
Yeah, it's a day and a half, and it'll be structured into 3 primary blocks. So you've got driver management, operational efficiency, and maintenance, right? And as always with FreightWaves virtual events, attendance is free and there's no pre-registration required. So come ready to learn and experience some information from the best. It's the future of truckload, right?
Yeah. Come get ready to learn, get ready to be really active on Slack, network, meet new people, learn new solutions to the problems you're having, and go from there.
Yeah, it's going to be awesome. And hey, listen, if you don't believe me and you haven't seen one of our virtual events, you can rewatch the 3PL Summit, which was fantastic, at live.freightwaves.com or on audio by looking up Freight Forecasts on your favorite podcast player. It was an exceptional event, as all of our events really are. We get tremendous feedback from them, and there's no doubt in my mind this one's going to knock it out of the park again.
It is going to knock it out of the park. I guarantee it. So do we have good news today, or a fond farewell, I think?
Well, yeah, it's not good news. I mean, this is kind of a fallout that's been going across the nation, really, and it's sad to see it go. But the Chattanooga Times Free Press reports the final notes will ring on August 15th at Songbird's Guitar Museum, as well as at its sister live music venues, Songbirds North and South, as the brick-and-mortar aspects of the 3-year-old facility at Chattanooga Choo Choo closes its doors for good. Also home to FreightWaves. It was also home to our last Christmas party. It actually was. Yes. And because of the COVID, the last time we had a chance together as a team was actually there. But I mean, live music venues are shuttering their doors all over the place, which is another sad effect right now.
It's very sad right now. So what do we have coming up on we have freight forecasting at 4 p.m.
Yeah, freight forecasting. Anthony Smith and I will be going through some of the latest economic numbers and looking at those trends and what's coming out, discussing the stimulus package that's coming out. What's the freight what's the state of the freight markets right now,
and our segments
moving forward.
Early in the show, right?
That's right.
And then Friday on What the Truck.
Yeah, so on What the Truck, Dooner and I are talking about how 6 River Systems acquisition by Shopify is advancing end-to-end e-commerce automation solutions. So the power of digitization and network fit for freight.
I've been fascinated with that acquisition. I don't know why, but I'll definitely be tuning in. Yeah. Yesterday on Put That Coffee Down, Dooner and I had Chris Jolly, the freight coach, on.
Oh, yeah.
And we talked about you got the sell, you got the account. What do you do now?
Yeah.
Are you going to do a Chicago style buy and sell where you have a split between the sell and the, outside cells and carrier cells?
Cradle to grave versus not.
Yeah.
That type of thing?
Yeah. Exactly right. And the process of handing off customers to the operators.
You guys come to a determination?
Well,
Was there a consensus among the comments or anything?
Buy and sell is easier to scale.
Sure.
But there's a lot of freight brokers that do cradle to grave, and they're going to keep doing a cradle to grave. So if you're doing that, what are the best practices for that?
Gotcha.
There's always improvement to be had, and process is kind of, no matter what you do.
I wanted to catch that one live and I missed it. Where could I get it?
You can get it at tv.freightwaves.com. It's on FreightWaves TV and Apple Podcasts and all of that. But that wraps it up for this Midday Market update. We'll see you Tuesday for the next one.